25. We're after three things today with the FOMC meeting. That's what we're looking for. One, we're pretty much assured of. The second one, we know a lot. We think we know about that one too. The third one, that's the toss-up, and that might be the most important one of all of them. So let's get into it here. So I don't have to continue to just be vague. We should get the announcement in about 15 minutes. We'll have to go through the technical implementation notes. We'll also have to go through the dots and see what the projections are. Not that the dots make all that much difference, but see if there's any real differences there. And then, you know, we'll see what the market reaction is today, at least the knee-jerk reaction. We also have to wait a little bit to get any comments from Powell to see if he kind of talks about everything like he did in October. Yeah, we cut rates, but we didn't, you know, a lot of the committee members didn't really want to. So let's get into this thing. Yeah, you know, these dissenters led by Jeff Schmid from the Kansas City Fed, they're not really hawks. They're not advocating for rate hikes. What they're saying is we're not sure about inflation pressures, when they really should be sure, as we'll see. Well, they're not sure about inflation pressures. Therefore, their argument is we can't continue to cut rates because we might cut rates too far, and that will actually add more to inflation pressures. Now, that's not how inflation works, and we know that, but they don't. And they believe that's how inflation works. And so the argument here is that they don't want to cut rates and they don't want to commit to cutting any more rates because they don't see a downside in the labor market, even though it's emerged more clearly. They don't see the downside in the labor market, and they do see an upside to consumer price risk. And therefore, their argument is let's hold off for quite a long period of time until we're absolutely certain that there is no tariff inflation risk, whatever happens in the real economy. We think the real economy will be relatively fine. So they're not really hawks. They're actually more chickens because they refuse to offer any sort of opinion about where they think everything is. They're just, hey, we don't know. We have to wait for however long until we make up our minds and we're completely confident about everything. So like I said in the intro here, we've got three things that we're looking for. One is the rate cut, which is pretty much, I don't want to say it's a done deal because you never know with empty-suited bureaucrats, but it's a pretty good chance that the Fed's going to cut rates today. And the markets have priced it in. By markets, I'm not talking about Fed funds futures. Forget that market. I'm talking about Treasury bills. Real money investors have said, we expect a rate cut here today. The second thing we're looking for is not really the dots, but the dots is a representation of how divided the committee is and how strenuous the Jeff Schmid tariff inflation section and segment and clique, whatever you want to call them, cabal, how strong they are and how much they're influencing maybe other members on the committee. Remember the FOMC minutes that came out 3 weeks ago for the last meeting at the end of October referenced many participants who are not really supporting a December rate cut. Maybe some of them weren't even supporting the October rate cut, although only Jeff Schmid was the one who dissented. But anything in the dots or really the projections that can tell us about how much that view may be actually taking hold on the committee, because as we know, and I've talked about before recently, the rest of the Fed is not thinking that way at all. You go back to the Beige Book. I mean, the Beige Book is really just a reflection of what the Fed staffs at the various branches think about, you know, economic conditions and monetary conditions to a certain extent. And the Beige Book, the last one that just came out a few weeks ago, nothing in it about inflation. Inflation was only referenced 6 times, which is a multi-year low. When you would think that it's the opposite because of how much, you know, Schmid and Beth Hammack and all the other inflationists on the Fed have gotten mainstream attention, you would think that the entire Fed is tilting hawkishly, when instead, in reality, the entire Fed is tilting the other way. So what we're looking for in the projections and the dots is to see whether or not the policymakers, the split on the committee, is as stark as it's made out to be by the media. Because the rest of the Fed, they're leaning toward labor market and layoffs. That was the other thing about the Beige Book. The layoffs showed up 18 times, which is, I don't say unprecedented, but it's the most we've seen in a very, very long time. The real story here, though, for me, the one that's really up in the air, is repo. And whether or not the Fed announces it's going to restart QE. Though they won't call it QE, they'll say it's fine-tuning their reserves to better match the needs of the monetary system and wholesale money markets, like repo. But in order to raise the systemic level of bank reserves, they have to buy some assets like they did in 2019, very likely to focus on Treasury bills, which opens up another whole can of worms. So what we're looking for is not whether the Fed's going to fix the repo problem, but whether or not they do something which tells us that the Fed sees the repo mess as a significant enough mess that it forces them yet again for the second time to alter their policies and plans. They're going to downplay it no matter what. We don't care what they say. We care what they do, because that tells us that even the Fed thinks it's serious. Or maybe they're just going to say, forget it. We're just going to let the repo market sort itself out. So it's not QE and potential for that we're looking for. That's really the story here. And to me, I think it's 50-50. I think there's a good chance that they do something. As you'll see in just a second here, there's reasons why the Fed might act because of some, we're already seeing month-end or year-end tightening. Year-end tightening is really starting to ramp up, and it's only December 10th. It actually started a couple days ago. It's early in December, and we're already seeing repo market tightness for the end of the year. Before we get into the rest of our stuff here, I do want to remind everybody we've got a couple Eurodollar University live events. The first thing is next Wednesday. We're going to be doing a webinar on the credit cycle, yes, but also these Eurodollar signals that we've been getting, tightness across the marketplace. What do they mean? What do they suggest about what the market thinks is going on with the cockroaches? What are the cockroaches really about? In fact, I just did a member Q&A yesterday, live Q&A yesterday, and somebody asked, should we really trust Jamie Dimon when he talks about cockroaches? I mean, the guy talks about inflation at the same time, stay away from U.S. Treasuries at the same time J.P. Morgan is buying the treasuries like they're going out of business or like they're disappearing. So the point is, yes, it's not just Jamie Dimon talking about cockroaches. There's a whole bunch of other stuff going on that suggests we need to pay attention to what's happening in the monetary system as well as the credit cycle. So next Wednesday, December 17th, 6 p.m. Eastern time, there's a link in the description of this live video if you want to sign up, or you just go to our website, Eurodollar University. And another thing, I just announced this week. We're going to be doing a Eurodollar University live event, President's Day weekend, February 12th to 16th, 2026. I think those are the right dates. I know it's President's Day weekend, 2026. We've got a whole bunch of VIP stuff together, seminars, again, talking about the credit cycle, but not just about where we are in the credit cycle or what it means, but also what can you do about it? Lining up a really good lineup of speakers for presentations, including maybe a presentation by a distressed debt credit fund. That I think that's going to happen. So again, it's not just about what's going on in the credit markets, but what can we do about it? How can we take advantage of what might be an opportunity? And then on Monday, President's Day, we'll have a bigger seminar we're going to focus on investments as well as monetary signals. And maybe, I think one of the things we were going to really talk about and focus on that Monday are political implications, because that's a topic that comes up all the time. The greatest danger facing the U.S., the dollar, the system, the world, isn't a dollar crash. It isn't a credit crisis. It's maybe something that you don't think about. So if you're interested in joining us on President's Day weekend 2026, there's also a link in the description of this live video for where you can book your call. If you're a serious investor, really want to know about everything that's going on, and a lot should be more clear by the time we get to February, a lot clearer by the time we get to February. Like I keep saying, things get more certain, not less certain. There's a link in the description to book your call to see if Eurodollar University Live is the right thing for you. It's here in Palm Beach County. We've got a lot of stuff already planned out. Should be a fantastic weekend. Plus, before I go here, the guests. We've got George Gammon, Hugh Hendry, Van Meter, of course, Brent Johnson, and last but not least, Mike Green. So like I said, it'll be well worth your time to attend that weekend, President's Day weekend 2026, Eurodollar University's first ever live event. Now let's do our pre-work here. We've got about 7 minutes before the Fed starts. The repo stuff. First of all, cockroaches. I mean, yesterday, Bloomberg and a bunch of other media outlets reported that the DIP loans for first brands, debtor in possession, we don't have time to really go over exactly what that is. I did that in Eurodollar University's deep dive analysis yesterday. So if you're a subscriber, go to that. However, first brands, there's all sorts of continued trouble there. An unusual trouble where you have the DIP loans being sold down by the DIP financiers. That's another sign. Lack of due diligence, which is the common, almost endemic problem that we get in all these credit markets and private credit problems, the cockroaches. And then like I mentioned before, we're already seeing year-end funding stress in the repo market, as was reported yesterday. Some of the repo rates, term repo rates too, are extremely elevated. If the Fed does cut today, like we all expect and like the market expects, some of these rates are already here on December 9th. This is from yesterday. December 9th, we're talking about 60 basis points above IOR, 55 or 45 basis points above the Fed funds upper limit, 50 basis points above it. I mean, just elevated repo rates. And whether or not that's enough to convince the Fed to do a not QE, that's what we're interested in here today. Because if the Fed does a not QE, where they said we have to raise the level of systemic bank reserves, that will tell us that they are taking this seriously. And there's a lot of people on Wall Street that have already gone to the mainstream media and said, yeah, we really think the Fed needs to do something here, because this volatility in repo, not going to be a good thing moving forward. So that's one thing we're really watching here today. As far as the macroeconomic stuff, you have the inflation side versus the labor market side. Again, there is no evidence of tariff inflation, though you do have to concede this one point to Jeff Schmidt and his group. Some of these price rates remain elevated, though the question is why they remain elevated, which we're not going to get into here. But one point I do want to make, the reason why it's elevated, we've talked about this before, Eurodollar University on YouTube and everywhere else. We know what that is. There's zero correlation with the Federal Reserve's interest rates. So one of the other points that Schmidt and Beth Hammack and others have said is that we don't want to cut rates, otherwise that will add some more pressure to inflation pressures. That's not how this works. And you can see that's not how it works. The consumer price numbers and consumer price rates have zero correlation with what the Federal Reserve does, either immediately or at long and variable lags like they always talk about. So as far as this argument that they don't want to cut rates because it might add to inflation pressures, that's their theory, but it has no basis in fact or reality. But everybody says this is how it works, so therefore they think that everybody can't be wrong, right? And there's zero correlation with the Fed's policy. And when you start digging into the consumer price numbers, there's even less evidence for tariff inflation. It's just the same consumer price rates that we've seen for the last couple of years. Even the core PCE deflator, you can see it's actually decelerating ever since really the, May or June. So even core price rates are decelerating, not accelerating. So again, no evidence today for consumer prices or tariff inflation. And you can go through the expectations numbers. These come from the Fed themselves. Even consumers are saying, we don't see any tariff inflation here either, especially the longer term expectations. Those have been anchored. And I went over these in a little bit more detail in I think yesterday's video on YouTube, so you can check that out. Markets. There is zero tariff inflation across the markets. Tips break-evens have been solid and steady. In fact, they're moving lower over the last couple months. Whether you look at the short run or the longer term or the five-year forward rate, markets are saying there is zero risk of tariff inflation. It's not just there's no tariff inflation today, there is zero risk, and there has been zero risk of tariff inflation this entire time. In fact, the five-year forward rate says there's been zero risk of any inflation other than the past price changes, the phase shift during the supply shock itself. There is zero risk of further inflation, yet, as we know, economists and policymakers, they don't pay attention to markets. They pay attention to models, which is the entire problem that they have. More recent labor market data, so shifting to the other side. So we've got Jeff Schmidt, the inflation, tariff inflation, we need to hold rates steady. On the other side, you've got Christopher Waller and Stephen Mirren, who are advocating a 50 basis point rate cut. We see labor market weakness, jolts that just came out for both September and October. Job openings were up again, but job openings are completely worthless. They're completely... They're overstate labor market demand, and the only reason anybody pays attention to them is because they still think the Fed pays attention to them. But as I talked about in yesterday's deep dive analysis at Eurodollar University, even the Fed knows that job openings are grossly, massively overstate labor market demand. So there's really no reason to pay attention to JOLTS job openings. But the rest of JOLTS, however, the hiring rate continues to be recessionary. That's why one reason why voters are so angry. There are no jobs out there. Hiring rate continues to be low. We're coming up here on the Fed decision. And another big one, quits rate. The number of quits absolutely plunged in October, which is not a good sign. In fact, it's the opposite from what you would expect if job openings are relatively stable. If there's stable labor demand, Americans wouldn't be quitting their jobs in less numbers or fewer numbers. They would quit their jobs in more numbers. The fact that they're quitting at this low level suggests that they are afraid of the labor market, and they have every reason to be afraid of the labor market, which goes along with all the consumer surveys that say the number one fear that consumers have. They talk about affordability, but what they're really talking about is jobs and incomes. So all the data continues to show that, which in terms of layoffs, those are rising as well, and reinforcing the fears that consumers have. According to the JOLTS, layoffs rose, and it's not just it's not even really the government shutdown. You see private layoffs and discharges are rising as well. And that brings us up to 2 o'clock. So let's see what the Fed has to say for us. Are we going to get a not QE? That's the question. All right. So let's take a look at the statement first of all. Yada. Dissenters. Oh, we got another dissenter. We got 2 dissenters now. All right, so we got a 25 basis point rate cut. We knew that was coming. Let's see here. Okay, so here's the 25 basis point rate cut. So 3.25% to 3.5%, the range for the Fed funds. Have declined to ample levels and will. There we go. We got a QE. The committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term securities as needed. So we've got the not QE 2019 style where the Fed is going to target Treasury bills, which is another problem all of its own. And here we have everybody voting for it except for Moran. I don't know how to pronounce that guy's name. You'd think I would figure it out by now. Who says he wants a 50 basis point rate cut, so no change there. And now we have another dissenter. We've got Casey Jeff and now Goolsbee, who's the Chicago Fed president. So we got quite a bit of stuff here from the Fed's meeting. Again, the most important thing to me, and I think it should be the most important thing to everybody else, is the fact that they did the not QE. So in the space of 2 meetings, the Fed was forced to terminate QT much earlier than they planned to, and then they had to reinitiate and restart bond buying, or bill buying in this case, which they clearly didn't want to do either, which means that, yes, this repo stuff is really starting to get to the Fed to the point that it's not what they say, it's what they do. All right, let's take a look at some of the other stuff here, the projections, the dots and all that stuff. Not that we care about the dots, but it does give us a little bit of a sense of what's going on with the models and the influence of some of these people. They upgraded, it looks like GDP, not a surprise there. Unemployment rate, they improved that one a little bit, moved employment up. So what they're basically looking at in these economic projections is that they're expecting exactly what they said earlier in the year. They think that this is all about tariffs and trade wars, and once the economy gets past tariff uncertainty, it'll start improving next year. So a little bit better economic results. That's what they're booking on. They're counting on is that we get past the year of tariffs and trade wars and get into 2026, and things will start looking a little bit better. So we have a rebound year in 2026 according to the Fed's models, not according to anybody else or the marketplace. As far as consumer prices, it looks like they're a little bit better here. So no tariff inflation in the projections, nor next year. So it's exactly what I said in the start of this video. The dissenters now, which includes Goolsbee of Chicago, what they're basically saying is, we're not sure there's going to be tariff inflation. Maybe we don't think we're going to see it, but we want to be absolutely positive before we actually cut rates any further, especially with the economy, according to these projections, starting to pick up next year. And whether the economy actually picks up next year is another matter, and that really, it's all tied to the labor market, which, of course, the Federal Reserve is going to downplay the dangers to the labor market. And furthermore, the Fed's going to say our rate cuts are going to support the labor market. So the lower that the lower they go with federal funds and their policy rates, the more likely they are to believe that gets us out of this mess in flat beverage and all of that stuff. And as far as the Fed funds projections, they lowered the top end here for 2025, so that's not really that important. And then they basically left everything for 2026. So does this count as a hawkish rate cut? Not necessarily. I guess it could be because there's another dissenter, but I don't think there's any surprises here, and I don't think the market will be surprised at all because it's basically what we expected, right down to the economic projections. We knew the Fed was going to upgrade the economic projections because they basically have been saying so. They've been saying that they didn't think there was as much downside case. Forget all of those negative payroll reports we've been getting. Those we'll take care of with our rate cuts to begin with. We think that the tariff problem is going to clear itself up, and that's the main issue for the economy. So 2026 is starting to look a little bit better according to the Fed's models. Again, according to the Fed's models, which are utterly, completely, and totally worthless. All right, so we got that. And now I just want to check one more thing before we wrap things up here. the implementation note to see what they're looking for as far as if they give us a sense of the pace of their purchases. Agreement operations. All right, they don't really tell us anything here about the not QE. If just increase the holdings of securities through purchase of treasury bills and if needed, other securities. Doesn't give us the pace of it though. We'll see if that comes up at all in Jay Powell's press conference. But either way, it's, like I said, it's an acknowledgement that the repo market mess is getting under the skin of policymakers, and really the technicians at the New York Fed have basically said, hey, look, we got to at least try to raise the level of bank reserves because this mess in repo is becoming quite the mess. And let's go back to where we were here. And you can see what I'm talking about here. Go through it real quick. Yeah, so we had, overnight rates, future overnight rates that are already, what this means is that counterparties in the repo market, borrowers in the repo market that are looking to secure, and I mean that in a couple of ways, they're looking to secure year-end funding, are already starting to do it. It's almost like, when you're looking to book your holiday and you know that you book airline tickets when you're traveling for the holidays, and you know it's going to be difficult, say it's Thanksgiving or Christmas or whatever. And so you start looking for tickets earlier and earlier and earlier because you know you're going to have problems. That's what we're talking about here in the repo market. So counterparties who are looking to borrow short-term funds over the year end have started to secure arrangements earlier than they normally do. What we normally see is, in really benign conditions, that you see year-end funding start to become a little bit tighter around December 23rd, 24th, obviously because, the last week of the year is usually holidays, not a lot of business gets done. So you see a little bit of tightening around the 23rd, 24th, maybe the 22nd, but we've seen a pretty significant level of tightening. By the way, this is not in the current marketplace. SOFR rates continue to be slightly elevated. I think yesterday it was 3.93%. There's nobody at the Fed's repo facility borrowing today, but that's likely to change as we move forward into December. But what's really happening is those borrowers who are concerned about funding availability at the year end are saying, we're starting to book it now to get ahead of what we think might be a rush of funding and also limited supply. And so when you have limited supply and additional demand for funding, what ends up happening? Rates start to go up, and they've already gone up a tremendous amount, which appears to have been enough for the Federal Reserve to initiate 2025's not QE. Now, again, they're going to say it's not QE, it's not intended to stimulate the economy, it's not response to labor market weakness, it's only some fine-tuning of our bank reserves in order to make sure that we continue to support smooth funding in wholesale markets like repo. That's what they're doing, or that's what they're going to say, but as I keep saying, it's not what they say, it's what they do. So the repo market has indeed gotten to the Federal Reserve, which is another not insignificant signpost, a marker in this progress, this credit market monetary cycle that we continue to navigate through. So going back and reviewing here, we got the Fed rate cut. That wasn't a surprise. 2 dissenters instead of just the one. Doesn't look like much change in the dots either way. So there's still some up in the air and uncertainty about what happens after December. A lot of it will be predicated on the ongoing and continued shift of the labor market to the flat part of the beverage curve. And as far as repo goes, yeah, we got the not QE, which is, like I said, pretty significant. So here we are, December 2025 Fed. And just one last point, one last note here. It's a pretty significant change over the last couple of weeks. Just going back to where we were, what was it, not all that long ago. After the October, the press conference performance by Jay Powell at the end of October made it sound like the December rate cut, the media went nuts with that. After Powell's press conference, the December rate cuts are completely off the table. But as I always say, once you pop, you really can't stop. It's, the Pringles are undefeated here. So whether or not, however the Fed proceeds from here, we're still hearing Pringles, and the markets are still expecting more Pringles. When you look at the marketplace, their interest rates are, just real quick, one last check before I sign off. The 10 years down to 415, not much movement. The 2 years at 356. 3 months SOFR futures, which we're not going to really tell us much in the short run, but initially we got some buying going on there. Knee-jerk reaction seems to be it's less of a hawkish cut than had been anticipated. Not a whole lot, but I wouldn't place too much emphasis on what's going on here today. which again, so just the biggest thing is not the rate cut. It's not the cents. It's not the, the inflation and tariff inflation is not the dots. It's repo. It's not QE. So thank you everybody for joining me this afternoon. I hope you have a wonderful Wednesday. Check out Eurodollar University live events, webinar next Wednesday, as well as Eurodollar University live February President's Day 2026. That's going to be a lot of fun and a lot of work and a lot of education to go along with it. So take care, everybody.